And we're now going to go ahead and we're going to begin our next presenter, which is going to be Larry Gaines, who is from Power Cycle Trading. Now, Larry is coming up next, and he has over 30 years of professional trading experience. And over 10 years, he ran the international trading desk for one of the largest oil trading companies in the world. Now, Larry used a top-down marketing technical analysis combined with his price cycle trading model and integrates it with options and futures. He will present you with information relating to his proven price cycle trading system and has been able to generate outstanding profits ranging from 5 to over 100% in 1 to 5 days, period. Without further ado, I'm going to go ahead and we're going to introduce to you Larry Gaines from Power Cycle Trading. Gary, you can go ahead and take it away.
Well, thanks a lot. I'm glad everybody's here today. Got a nice full crowd. Let's get going here. First off, the following webinar is purely educational. Any stocks, options, futures mentioned do not constitute advice and should not be construed as a recommendation. So thanks for the introduction. Yeah, I've been trading for over 30 years and previously ran for over 10 years one of the largest oil trading companies, international trading desk out of Bermuda. And it was a great, fantastic experience. Was able to learn a heck of a lot. And we were one of the first groups to trade over-the-counter options on crude oil. But you know, we traded everything. We traded forex. We traded foreign exchange. We traded all the futures markets, and we traded just a lot of cash, crude oil. So had a vast amount of experience in all the different areas. And then we started trading options back in the mid-'80s on over-the-counter crude. And that was where I got introduced to options and really kind of fell in love with it, and that's kind of been my passion ever since. But you know, still like to trade the futures and everything else, but options are just real stimulating, and the word option just gives you so many different opportunities. Went on to launch the institutional over-the-counter crude oil brokerage option desk for the largest privately owned oil brokerage company in the world called PVM Oil out of London. And that was another fantastic learning experience for me as well. Got to do a lot of different option structures for the big institutions, the big banks and all the major big hedge funds, and so learned a heck of a lot there. So that being said, I'm here today, and hopefully I'll pass on some things that will help you with your trading, options or anything else down the road. I'd also like to get a feel, I always like to get a feel for everybody that's at these presentations to see kind of where you are or where you're headed in your trading. And I'd like just to get a, if you could just put in a yes or a no, how many of you would like to be more active in the markets trading as a full-time job, but you're just not feel that you're there yet? Maybe it's a confidence level, who knows, but just like to get a feel for all that. Yep, seeing lots of yeses. Well, it brings back a lot of memories for me because I used to be just like you, and I still vividly remember when I went out on my own trading. I was at first very nervous about having my own money on the line. It was a totally, completely different feeling when it was my own dollar. And I have a wife, 2 boys in college, mortgage, plenty of expenses, so I really understand, about having your own money at risk. Now, when I was running the international trading desk, I found myself in plenty of nerve-wracking trading situations. But at the end of the day, it really didn't affect me, personally, unless I blew up my boss's account, which I never did, thank goodness. It wasn't, my money at risk. It was the guy I was running the desk for, and he was a very wealthy owner of the company. So, it was a completely different feeling when it started to be my own money. Now, trading my own account really improved once I learned how to better control my risk. And the huge breakthrough was learning how and committing to limiting my downside in any trade taken. And I do this by using options and option spreads. Now, once I committed to this, then I could really sleep a lot better at night. Now, I really also believe that probably 60 to 80% of a trader's success comes from how you emotionally handle the markets, and it can really come down to keeping in check, those big emotions that will surface from maybe fear or greed in the marketplace. And you know, the really cool thing too is that you know, if you know your maximum loss that you can incur based on your trade setup, for me it's using option strategies, then these fears are really relieved. And the other cool thing is that option strategies allow you to completely control your risk by using option spreads type setups. You decide how much you want to risk, and you're, you know, to put on a specific trade, and then you structure it accordingly. And it's really that simple, and that's why, you know, I'm excited about talking to you guys here today about earning strategies using options. Now, even though the last couple of weeks we've actually had some increased volatility, from a long-term perspective, we've really been in a time of very, very low volatility, making it harder at times to, you know, find those good opportunities in options. But with, you know, earnings season, stocks tend to get some really great spikes, allowing the, you know, the smart trader to capitalize on that uncertainty, and it comes 4 times a year. So it's actually a really exciting time of the year, especially if you're an option trader, because you know, you get that increased volatility, and for an option trader, that's really, you know, it's kind of like hard to beat if you can do that, and then, you know, trade accordingly using spreads. So let me ask you guys this: what if you could add a new stream of income now? Would this change your life? And if the answer is yes, then do you have a plan to achieve this? Well, I'm going to talk today about a 5-step plan for earnings season success, since we're just really launching into it, and this week was kind of the start of it. We've got tons of earnings coming out over the next month. Now, so what I'm going to talk about is how to find volatility, use it to your advantage, a screening process to find the most probable winners, a vital 9-step stock trading checklist I use, my favorite trading tool for earnings, and my favorite kind of non-directional earnings strategy I'll discuss. The main income streams, you know, that you learn over years can really take considerable time to in education to figure out and to make work profitably. But if you could learn in only a few hours how to add a new income stream by creating option spreads to capitalize on stocks reporting earnings, would that have an interest to you? And I find that earnings have a great potential, you know, for that 4 times a year when people are, you know, nervous about the markets. They don't want to enter the market because of earnings. And what I tell my clients and members is that, you know, you need to look how to embrace risk rather than fear it. And if you understand earnings and the opportunities they can provide you, then you can really capitalize on them 4 times a year and not really have to worry about sitting on the sidelines and missing some great opportunities. But having said that, you know, the whole thing is that, have you been confused over these earnings cycles on these weird movements in stock prices during an earnings announcement? And I call this the earnings confusion. Have you noticed how earnings are horrendous and the stocks goes up, or earnings are off the chart fantastic and they go down? And it's like, then what's up with this, you know? When a company has an earnings conference scheduled, many times there's speculation not only into the accuracy of the projected earnings per share, but also other factors that could pop up that you're not aware that they're going to announce. You know, a great example was the last earnings season when Apple said they were going to do a 7-for-1 split, and the market just, you know, erupted after that. So that was a kind of an earnings surprise, and that's what tends to happen. So the uncertainty of all this typically causes volatility in the shares themselves, and the diamond in the rough is actually that temporary parabolic increase in the exchange-listed options on the underlying shares from that volatility. Now, here's what tends to happen. Traders, you know, tend to stay on the sidelines going into the days leading up to the earnings conference, and you'll have a lot of the big guys, the institutions and the hedge funds. They'll start swapping out their shares of stock and converting to long call options so they can, you know, still participate in a rise should the shares move higher, but at the same time they want to limit the potential loss should the shares trade lower. So you see all this demand come in, you know, at one time on the call buying. Now this causes the call options to trade in many times at drastically expanded volatility levels. Additionally, then you have the put buyers coming in to protect their long positions, and that forces option prices higher as well. So you have all this demand coming in at one time, and that's what increases the volatility, and that's what you want to try to take advantage of as a trader. So as an individual trader, you can take advantage of all this uncertainty and volatility in order to capture profits, no matter what those crazy earning reactions are. It's just about using the right setups and strategies during this 4 times a year. So step one is to identify and qualify a particular stock by looking at its past performance heading into earnings. You want to find those stocks that have their earnings released closest to a weekly option expiration or the week of its monthly option expiration. So like last week we had monthly option expiration, and it was a really perfect start to the earnings season for any stocks that you were looking to trade into an earnings release. With the expiration of Friday, you could still use monthly options. So what I've found from when I first started trading earnings is, let me kind of give you a quick example. Getting the pen. What would tend to happen is that you have an earnings coming out, let's say, on this date here, and as you come into an earnings time frame, that implied volatility starts creeping up because of all that buying interest coming in. So what I used to do, I didn't really focus as much on those options that were expiring during the week of earnings. I would just tend to buy an option that might even have 20 days to expiration or 30. And what would tend to happen is that you would get, here's the day that the earnings were released, and let's say the price closed here, and the next day, it gaps way up here. So if you've done an earning strategy based on maybe an up move or something, you got that high lift, you're looking good. But then if you have too many days for the market to recognize that move, then all of a sudden after 4, 5, 6 days, it might reverse and go the other way. So what I like to do is use that short duration option to capture an earnings move on a directional play over a 1 to preferably 3 days. So that to me is kind of the sweet spot. So from that point of view, then I tend to only want to use weekly options or options that are expiring during the week of the earnings announcement. So last week was a perfect example for that, since we did have monthly options expiring. So you could have done a lot of different earning plays with that short duration time frame, which I'll go over a little bit more in depth here in the next few minutes. Step 2 is you want to look back to see what volatility has done previously to a stock as it moves closer to its earnings release and after. So there are also like 3 different types of trades that you can place off a cycle for earnings. So the first cycle for earnings is that volatility leading up to its earnings release. So typically you're going to have, you might find a really nice trending stock, and then what you want to do is you're going to want to buy options because they're going to be cheap, they're going to be lower implied volatility, and then as it gets closer to its earnings date, say it's over here, that implied volatility is also going to be spiking up. So you get a compounded effect. You get, if you're directionally the price is moving up, or it could be moving down, you get into that trend, but the implied volatility on the options makes the options that you bought go up a lot faster. So that's one trade going into an earnings release. And this typically you want to look back 2 to 3 weeks and look to get into a trade 2 to 3 weeks before earnings. So the second type of trade you can place during an earnings season is what I'm really going to talk about and focus here today, is on earnings release. And so on an earnings release trade, that's the day that earnings are announced, you get, you've got the implied volatility extremely high. And so there are a couple different strategies you can play, either for a big directional move to the upside on the price, or what we call volatility collapse, where that implied volatility that's so high collapses and it goes to 0, and you take advantage of that. Now the third cycle trades you can play off an earnings season is once an earnings announcement comes out, there are a lot of trades that consistently will trend in the direction of that earnings release. So let's say, for example, Google, which announced Thursday, it had a nice pop to the upside. Now, Google's one that tends to trend. So let's watch. I'm going to be watching Google now to see if it trends for the next 2 to 3 weeks, and you might get in a nice uptrend off of that earnings announcement. So 3 things to take advantage of. So as a trader, if you recognize these 3 different scenarios, then you can take advantage of them, or maybe all 3. Now today I'll be focusing more on number 2, which is that earnings trade into an earnings release. So the smart trader is going to be looking for that dramatic increase in front and second month volatility a few days prior to that earnings call. Now, stocks front month volatility may normally be around 30%, but when its earnings are a couple days before option expiration, its volatility can easily move to extremes. Now, here's an example. This was on SanDisk, which announced their earnings on Wednesday. And you can see here, this was going into the earnings release on Wednesday. You can see the implied volatility here went up to over 72%. Now you can look back at the other option series down here, and you can see that normally SanDisk, is in the 30s on its implied volatility, but over doubled, up here going into 3 days before option expiration on its earnings release. So again, here's another example of weekly options. 3 days till expiration here, 72% volatility. So this can offer a great opportunity for an earnings release for the trade to maybe go up, or spike down. You don't care if you know the strategies to use, and that's what we'll be discussing. So this is what makes the stock a potentially great trading candidate. Normally the volatility will double, and in some cases it can be even more extreme than that, and this is what you want to look for. And it's for this reason it's essential to have a watch list of stocks to monitor closely, due to the fact that they may not all present an equal opportunity for an earnings trade. So remember, the goal is to take advantage of the temporary rise in volatility. Now, a stock's option, will need volatility, and without volatility, you have no price movement. Without price movement, you pretty much have no chance to turn a profit. So how can you find that volatility and then turn it into your advantage? First is, and to me, one of the most important aspects of trading an earnings release is the volatility. Now, I've put together a process that I use for building a high probability trading list of stocks to trade into their earnings release, and it looks exclusively for high volatility stocks with weekly options, or options that are going to expire. It could be a monthly, expiring that week of its earnings release. This screen uses and tracks the following data on all the stocks that I'm looking for that I select. So I screen for certain volatility. I want high volatility, so I have a certain element that I put in there to screen for that. The stocks that I'm looking at must trade over 1 million shares per day, so they have liquidity, and this gives me a good list of stocks to trade from. I track the straddle costs for volatility. That's how we're going to, figure the implied volatility. I use the pre-earnings implied volatility to forecast the expected implied move of the stock after its earnings announcement, and this is very key in order to know where it potentially can go and how to set your targets and your strikes. I look at prior post-earning moves from 1 day all the way to 21 days after. I'm looking to see what it does consistently after an earnings release. Does it spike up hard and continue, or does it chop around, spike up, go down, go sideways? And what does it do post-earnings? Does it tend to trend? So I look at all that to add to my watch list. And the historical stats from past earnings, this shows trends, so I track that in my screen. One major element to trading earnings release successfully is knowing that stock's implied volatility, or what we call the expected implied move, and then how to use this information for the trade setup. Now, this number is expressed as a percentage of the stock's price and indicating a 1 standard deviation move over the course of the stock's option cycle. So this is, the statistical talk for option trading, but it's not that difficult to understand. So here's a little example. Here's the implied move. So the implied move is what the marketplace expects the price of a stock to do in theory based on the stock's at-the-money option price. So for example, this is an example. I'm going to call this Google, and its expiration is in 3 days. So its options are expire in 3 days, and its expected implied move that the market's giving on Google at this point in time is a plus or minus 4% move up or down, which is a plus or minus $20 per share up or down within 3 days, or into its earnings, or not earnings, but into its option expiration. So the basic theory here is that the market's saying that Google 68.2%, that's a 1 standard deviation, is going to close between $480 and $520 by option expiration in 3 days. So this statistic can offer you a lot to trade from. So if you know that it only has a 68% chance, or it does have a 68 or greater chance that it's going to be between these levels, then knowing this 520 to the upside, 480 to the downside, you can use to structure trades. And then the other really cool thing is that based on statistics and this distribution curve, that it only has about a little over 15% chance to trade outside of 520, greater than that, or below 480 by expiration. So these are the statistics an option trader's looking at in order to structure trade setups. So the implied move is what the marketplace expects the stock to do in theory, and this is the fastest way to calculate that move. You know, although it's not 100% accurate, implied volatility and using the implied move of an option is a very useful, and it's also a free tool for forecasting the stock's price movement into expiration. Now again, it's what the marketplace expects the stock to do in theory. It's not what you think it's going to do. It's what the marketplace is expecting it to do based on statistics, and these are free, you know, based on your option platform. So, you know, if you didn't have moving averages or some type of other indicators, you could just use this free tool to establish support resistance for any stock, you know, out there that's carrying options based on that cycle or that series of the option. Now, step 3 is I go through a pre-earnings checklist to systematize the trade setup process, which is greatly important for making the best trade selection. I like to keep things as systematic as I can as a trader, because it, you know, if you have systems in place, and it helps you to prevent you from making mistakes. And you know, a lot of your learning comes from past mistakes. So I incorporate a lot of this stuff into my checklist and to my trading rules based on mistakes I've made in the past. So within this checklist, I look at the stock must have weekly options and have option liquidity. It must have a high pre-earnings volatility, because I want either big move up or big move down, or I want to have high implied volatility so I can capture a volatility collapse. Stock must have had price moves of greater than 3% over its last 3 earning cycles, and a price over $50 a share. So I like to trade prices that are high price stocks using options. Because why is that? Because the higher a price stock is, a small percentage move is still a great dollar move as a percentage, as a profit. So you know, if you've got, example, a great one for option trading is Priceline. So you know, Priceline's trading over $1,000, right? This is one good one. If it goes up 1%, that's $10 per share, right? Now that can be a lot of money, and trading options, you can get into Priceline, you know, $100, $200, you know, so it's a real easy way for even a small account to trade high-priced stocks to make, you know, big dollar returns, versus if you're trading a $10 stock, that 1% move is only $1. So, you know, you can't make a lot of money on a $10 stock trading options, especially if you're looking to capture some big option move after an earnings or some other type of market announcement. So I like to focus on stocks at least over 50. I will usually look at, I prefer, looking at $75 and greater, and I love it when they're over 100. That even makes it better. So Apple used to be the kingpin for me, but since they did a 7-for-1 split, it's still good, but not as good as it used to be. Apple has such a strong tight bid-offer spread. When it was trading the 500s, it was just the perfect stock. Now, calculating the implied stock move on the day of its earnings is also part of the checklist to know where it is right there going into its close before its announcement, and then performing an earnings price target analysis. I do that on every trade. Select the appropriate weekly option strategy. Select the option strikes and expiration. Select date of entry. Determine exit plan. So these are all steps that I outline in my plan. Now here's a matrix that I use to analyze a stock, and this is what I do for every stock I'm looking at. Here's SanDisk that released its earnings on the 16th. So this is SanDisk. This is the price at the close, going into its close. It was trading at 107.83. Now I've got the implied moves here that the market gives me. I've got all these lined out that I keep. I have historic data on this. So you can see from this earnings, going into its earnings release, SanDisk had an implied move the market was suggesting was going to move up or down plus or minus 5%, over 5%, 5.9%. It would go up or down. And you can see in April they were forecasting 5.43, January 8.28, October 5.272, July last year 6% and 7%. So I look at that, I take the average, kind of see what the consistent average has been. You can see that SanDisk tends to have an average implied move based on day of earnings release of about 6.4%. Now the second really important area is then to look back, what did it do after the earnings release? So one day after I look at, and then I look at expiration, which could be 2 or 3 days later on Friday, what did it do on that last day? And then I'll even look out, that 21 days to see if it still trended. And from this data, I can then see if there's a consistent pattern. So if you look at this, what do you see? Well, you can see there is a consistent pattern that it usually beats or exceeds the implied move that was being forecasted. So one day after, the average has been about 6.92. At expiration, it's been over 7%. Now there's always going to be an outlier, of a low here, but then look what happened into expiration. So this tells me on SanDisk it's a really great candidate for a non-directional options strategy that takes advantage of maybe a bigger price move up or down through the targets that these implied moves are giving you. So here's a target high, and here would be a target low. Sorry about the scribble. Based on this implied move. And what this tells me is that SanDisk statistically tends to exceed these target highs or target lows. So knowing that, then I can structure the appropriate trading spread based on this information. So it's important stuff. And what is trading about? Trading is about probabilities, right? So it's trading, as a trader, you want to try to trade the most high probability trade setups to have consistent winners and have a consistent equity stream. So really it's about, you want to protect your principal and you want to have a consistent equity stream. I don't want to get off in rabbit holes, but as you go on in trading, what would you rather have? Would you rather have an equity curve that's like this? There's a lot of heartburn in that. Or would you rather have an equity curve that's, like this, but moving up? Now, as the older you get, you might, when you're young, you might be able to handle that because you think, oh, I can make this back up. I've got, you're like invincible, right? But as you get older and you have your capital, you don't want to give your capital back. So you tend to get more conservative and you want to take these trades. You're not looking for the big home run hitter every time. You're just looking to chip away, chip away, chip away, and increase your your principal and protect your principal and increase your return on it. Now that's the way I look at it, and the really good traders that stay around for years and years and years, they're going to have a consistent equity curve. Now you might get a good trade every now and then, it pops up, you know, take advantage of it, you know, and then you're going to continue on that equity curve. And you might have a trade that blips down, but if you control your risk, you're not going to have one that blips down as much, right? So you're going to maybe let your winners run. You might have a good blip up, and then you just keep going that solid little tiny equity curve versus this one, up and down, up and down, up and down. That you're not going to survive. So that's why, you know, using options and knowing these kind of strategies and which one to use can really be valuable. Now step 4 is the tools to use, and I talked about implied volatility, but the other one is the weekly options, and they are one of the most lucrative trading opportunities that still exist today due to their defined risk, low cost, and highly levered returns that they offer you. And what are the mechanics that create this? Well, I use weekly options, again, for all my earnings trades, and I kind of told you why, to take advantage of the 2 key elements, which are time value and implied volatility, which I touched on earlier. It's the combination of these 2 elements, when used correctly, that create a winning low-cost, defined risk trading formula that will generate unmatched high returns on your trading capital and in a very short period of time. So if you're not familiar with options in the time curve, this is a weekly option. They come out on Thursday, every Thursday, and then they expire 8 days later on the following Friday. So basically, it's if the price goes sideways and doesn't move at all, the option that you buy is going to go down about 1/8% or 12%, and it really tails off, you know, from like a Wednesday to Friday, and it's like, you know, option time decay on steroids. So it's important to understand that, and then if you understand this, then trade and have this, you know, to your advantage. So you want to trade with you want to swim with the current, you're right, instead of against it. So by understanding time decay and then how to utilize it in your spreads or your trading strategies can really help you not fight the current and use it to your advantage. So if you know which weekly option strategy to use for an earnings trade, how to construct the trade and when to execute the trade, then weeklies can produce some exceptional fast profits due to the incredible leverage they provide, making them the perfect trading vehicle for earnings. So they are the best way to go for earnings unless you have a monthly that's expiring in that same week the earnings are released. So how do you do this then? So to select the right strategy, I've got 4 different strategies I use, and then I'll do what I call a comparative option strategy analysis to decide which is the best, or maybe a combination are the best. Now when constructing an earnings option strategy, the risk to reward or return on your capital at risk between the various strategies used are then compared to select the best risk to reward for your trading goals. Now, I tell all my clients and members that there's no perfect trader, there's no perfect trading system, so you know everybody's different, and trading is really just kind of a journey, and it's a consistent learning experience and journey. I learn every day something new, basically. I mean, there's so many smart people out there, and I've got so many great members and clients. They're a lot smarter than me, you know, maybe academically, and they have some things that I learn from each and every day. So, you know, again, there's no perfect system, there's no perfect trader, but what you need to understand is just kind of the basics of all these things first, and then you can decide, does it fit your style, your lifestyle, your trading capital, those things. So whatever you use for your trading, whatever strategy, in this particular situation, these strategies have to be measured versus your lifestyle. You might not want to be staring at a screen all day, or you might have a smaller capital account than Charlie, who has this huge account. So your goals are going to be different, so you need to understand that and then pick the right one. But what I present is all the different good ones to select from, and then you can use the one that best fits you. And there are going to be times when more than one strategy can be employed. Now here's some trades. These are trades from 2 earnings cycles, from the first quarter of this year and the second quarter. And this is using one of my favorite non-directional option strategies, using weekly options. Now what you'll notice here is that the duration of these trades were very short. You know, they were 1 day to 3 days. Now even 4 days to me is too much, but for Apple, you know, I'll look to trade that always. So you can see the returns are, you know, about 25%, a little bit greater, but they average around 25. Now with option spreads, you can structure them to be more consistent or more conservative, which will give you a smaller return on your capital, or more aggressive with more risk but a higher return. So then that's up to you. I mean, you know, you can make 100 to 400%, you know, on some of these earning trades or trades period, but your winning percentage will usually be very low, maybe 20 to 30%, versus, you know, maybe making on options 20 to, you know, even 40%, and having a winning percentage of, you know, 80% or greater. So for me, I like higher winning percentage to keep that equity curve more consistent versus, you know, that big swing up and down. So these are trade setups that are nice, that are consistent, and they don't require a lot of time once you have done the homework and put them on. So that was from the first quarter. This was that second quarter, and now these are all the same one non-directional strategy I'll show you in just a second. And you can see these are all short trades. These are all pretty high volatility type stocks. You can see Google, VMware, Netflix, Wynn, Tesla, and they're a lot of fun to trade. You know, I mean, if you want a little bit more excitement to your life and understand the risk, then it's a really great time of the year for you to take advantage of versus, you know, being out of the market. Now step 5 is then, okay, what is the strategy and how does it work? Now there's several methods to capture profits from extreme price volatility that surrounds every earnings season, and each method works best based on certain circumstances. Now I don't like to spend a whole lot of time watching trades all day long, so one method I use and teach most often involves almost no work once the trade is placed. It's basically comes down to 4 steps, and you buy 2 options and you sell 2 options. Now this may sound like a lot of steps, but once you understand the method, you just use the same method over each earnings season. So it's, you know, really quite simple once you get it down. So here's the trade. This was on Amazon last earnings cycle, and so it was buy 1 Amazon 345 call, cost $660. Sell 1 Amazon 350 call, collected $495, so your net cost was $165. Now these type of structures are also, you know, something that you can do with a small account, so that's what also makes it nice. You can take, you know, a small account and grow it, you know, using options. Now step 2 is buy an Amazon 325 put, costs you $620, and then you sell an Amazon 320 put, collected $455, so your net cost there was $165. So your total cost then was $330 right here, and the spread was $350 minus the $345. That gives you your spread, $500 wide, less your cost, your capital at risk of $330. So the net profit per option contract on this setup was $170. So the trade made $170 per contract before commission. The way it was set up and structured, it was a high probability trade setup based on the trade selection. The maximum potential loss was defined at $330 per option contract. The trade only took 1 day. So, you know, if you had $1,650 to invest, you could have bought 5 contracts times $170 profit. That would be $850. Or if you only had, you know, a capital account where you could only afford that maybe a $300 potential loss, or it would be less, that was your max loss, then you could do 1 contract and make potentially 170. So, you know, your cost was $1,650 on this. Your total profit on 5 contracts, $850, 51.5% return, and that was over a 1-day period, and that was based on this trade structure and using weekly options, which provides you some great opportunity for leverage, defined risk, etc. So really the time for this entire trade, once you understand the setups, is, you know, takes about a half an hour to an hour to set the get the trade in and have it executed. But and once it's done on this type of trade, you can pretty much kind of leave it alone until expiration, and there's not a whole lot of trade management to it. So this strategy is the Iron Condor. It's a non-directional option strategy that is ideal for trading earnings releases, and it can be used to capture explosive price moves up that exceed, you know, looking for a 1 standard deviation implied move the market makers expect, or it can be structured to capture the volatility collapse that happens after an earnings release, or both. So it's a really super trade setup. Now, will every trade be a winner? No. Do you need to be able to find the highest probability trades? Yes. You need to understand how to do that. And the high probability, with the high probability type system, you can have a very high percentage of winners, and it all really comes down to a very selective and systematic selection process for these trade setups. Now, what we covered here today, went over the 5-step plan for earnings success, how to find that volatility for these stocks and options, a screening process, a 9-step checklist, my favorite trading tools, and my favorite non-directional earnings strategy. Now, I know there are a lot of questions here that I want to get to, and I also want to, tell you more about how you can learn these type setups and strategies, and I'll answer all those just in a few minutes. And I also like to tell you that, I'd also like to say, again, thank you for letting me be here today to share some of my trading knowledge and experience, and hopefully this will help you. Now, I realize that a lot of you don't know me at all. So before I get to your questions, I'd like to show you 2 short notes that I received just last week from 2 of my clients from my past earnings course that I did. And if you have a couple minutes, just read through these. These are just last week I got from Alan and Michelle. Now, to know that I'm making a difference in someone's trading is super rewarding if you're a teacher. So if any teachers are out there, you know what I'm talking about. But these were 2 of my clients that, have been with me and taken some of my courses. So it was a great thing for me. Now, what I'd like to do now is, I want to talk to you about how you can learn more on using weekly option strategies for earnings.
Larry, I hate
some simple things you can start doing now to take.
I hate to interrupt you. We've gone over the 45 minutes, so if you want to go ahead to begin it, I'll wrap it up. If there's any information you'd like to share, any contact information.
Let me give you, I'm sorry, I thought I had an hour. My mistake.
No worries.
So I'd like to give you this link here. It's powercycletrading.com/light. Okay, so put that in, and what you're going to get here, I'm going to give you, it's a $97 product. I just did this course this past week. It's all recorded, 3 hours. You get the 3-hour recording, 225-page PowerPoint, my 60 best current stocks you'll get, and also if you sign up today, since I don't have much time, but anybody that signs up today, you're going to get my live accountability and support call that will be 2 weeks later. So all this is just $97. If it doesn't work for you, just send me an email and I'll give you that your money back. But it's a great course, and it covers my 4 favorite option strategies that I use, non-directional, my Grand Slam strategy that's really cool that you'll never see anyplace else. This is unlimited upside with a defined risk. And I teach you how to use implied projected move, how to set your price targets using price implied move, how to trade implied moves up and down, all this. And I give you my earnings trade library of those 22 trades that shows you every structure that's used in here, how it's set up, all the information put into it. and my 60 stock list, so you don't have to do the work for you. All of this and this accountability Q&A follow-up call in 2 weeks for $97. So if you just put in powercycletrading.com/light, you'll be in. So thank you very much for your time, and hope to see you guys in the future.